Every day, this wheel keeps turning. Thousands of people step inside, ride the cycle, and pay for the experience, over and over again. And in a strange way, options trading works the same way. Because with the wheel strategy, we are not chasing random price movements. We are using time, repetition, and probability to generate income from the same company again and again. The wheel keeps turning, and every rotation has the potential to pay us. This is the wheel strategy. The wheel is simple. First, you sell a put option on a company you would not mind owning. If the stock stays above your strike price, you keep the premium. If the stock drops below your strike, you may be assigned and buy the shares. But here is the important part. You do not mind owning the shares anyway. So instead of chasing the stock, you get paid to wait. And if the shares are eventually assigned to you, the second phase begins. Now you sell covered calls. That means you collect more premium by agreeing to sell your shares at a higher price. If the stock stays below that price, you keep the premium again. If the stock goes above it, your shares may be called away. And then the wheel starts again. Sell puts, get paid, maybe buy shares. Sell calls, get paid again. Let's say I want to own Coca-Cola at a lower price. Instead of buying the shares immediately, I sell a put option. For example, Coca-Cola is trading around $81. I sell a put at $78, and for taking that obligation, the market pays me premium up front. If Coca-Cola stays above $78, I simply keep the money. But if the stock drops below $78, I may be assigned the shares. And honestly, that is completely fine. Because if I end up owning a quality company like Coca-Cola at a lower price, is not a bad outcome at all. Now, the second phase begins. Once I own the shares, I can start selling covered calls against them. So now, the same shares begin generating additional monthly income. That is why the strategy is called the wheel, because the cycle keeps turning. Sell puts, collect premium, own shares, sell calls, collect premium again, over and over again. But the wheel is not free money. The danger is choosing bad companies. If you sell puts on weak stocks just because the premium is high, you can end up owning something that keeps falling. That is why you should choose stable companies. Companies you understand. Companies you would actually be comfortable owning. Companies where assignment is not a disaster. Because the wheel only works properly when you are happy with both outcomes. Either I keep the premium, or I buy the stock at a price I already accepted. The wheel strategy is not about getting rich overnight. It is about turning capital into cash flow. It is about collecting premium, managing risk, and using patience as an advantage. Most traders chase movement. But with the wheel, you are not just predicting direction. You are building a process where waiting becomes income. This is how I use options to create monthly cash flow. And on June 1st, I'm opening my real portfolio to show you exactly how I close and open positions this month, how much premium I collected, and how I manage them step by step.